Hello and welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us Ramesh Mantri, CIO at WhiteOak Capital Mutual Fund. To begin with, I'd like to thank you for taking the time and joining us for this interaction, Ramesh.
It's a pleasure to be interacting.
Now, can you share what initially drew you to the world of equity investing after your journey through CA, then an MBA, and becoming a CFA?
Yeah, so actually, the story started even before this. Even before the education. My family, my extended family, they were all into business. So I was initiated into, in traditional Marwari families, the kid tends to attend the family business even before he passes out of 10th class. So your summer vacations are attending to your father's business, right? That's what you do in summer vacation. And other thing, I did my schooling early years in Visakhapatnam, Andhra Pradesh, and I had a lot of interest in reading. And we used to so I used to ferociously read the whole newspaper, including the business section of it. And of course, was very integrated. I think my initial recall of the market is from the time of the 1992 Ashoka uh, scam. My father used to apply a lot from, into those IPOs then, as a retail investor and used to fill a lot of application forms. And there were a lot of IPOs at that time, and those IPOs typically used to come at par. So there was a lot of money to be made if you got allotments. Of course, many of those companies went up, which just typically happens. So those were the initial years, and because I used to read a lot and follow all, so I got very interested in, generally in the broader, the world. And then when I was doing my college in Calcutta in St. Xavier's College, Calcutta has these street uh, bookstores, where they sell a lot of books on the footpath. And there I picked up this book, One of the Wall Street by Peter Lynch. And that's where I really got hooked into it. I used to also read with my graduation, I was also doing my CA. So I also used to read a lot of business magazines, all your, Business Today, Business World, and, CFA used to have a journal, and I got initiated a lot into that really. But I would say the real fire came once I read Peter Lynch, and this is what I wanted to be. And of course, then I followed it up by reading on Warren Buffett. And then once you take those paths, then you're really hooked into it.
Mr. Mantri, you have a rich career starting with your time as a credit analyst at CRISIL and then moving to Alden Global Capital. Could you share a couple of pivotal lessons from those experiences that have shaped up your approach towards the fund management?
Yeah, so great. Thank you for this question. So first, I started my career in 2003 with CRISIL as a credit analyst. The month I passed out of my business school MBA was like the multi-year bottom of the market, the March 2003 bottom. So there was, of course, no opportunity in equity market. And of course, credit was doing very well. There was a fixed income rally going on. Credit was doing well. So CRISIL, I joined CRISIL. It was an extraordinary 2 years in CRISIL. CRISIL is a extraordinary great place for a fundamental analyst. I think the great background in starting with credit is that you're acutely aware of risk, right? So I believe a good grounding in credit is good for anywhere because in often equity markets, particularly people who start their career first in equities only understand upside. But because credit is only about entirely focusing about the downside risk. So I entirely started my career focusing only on the downside risk. And then, of course, in 2005, I joined this US hedge fund that was investing in India and South Asia and equities. And, one of the real, and of course, I joined that in 2005. That was the go bull market in India. Honestly, you only learn a little bit after the first crash in your career. And I say, and as someone wise investor said, you actually have to experience 2 full market cycles to two cycles of, bull and bear before you start understanding and, having a balanced perspective. So of course we got sucked into it, but because of my credit background, the focusing on downside risk, doing basic due diligence, not believing what people say, but verifying facts. So one of the most important messages always stayed with me is, and we used to do a lot of small cap and mid cap investing in that period, is always verify. You should always verify the facts. As basic as site visits and plant visits tells you a lot about companies. So I have been to plant visits where I've shown a plant of some other company. Plants that were very different from the situation of the plant is very different from the story the company is telling you. So very basic of just verifying facts. Particularly when you're investing in small and mid caps, and that's discipline continues with me. 20 years plus since I started my career. But even today, I take a lot of initiative to make sure our teams and myself take the initiative to visit companies on the ground, verify the facts from the company, when I mean the company, the plant, the people, the ecosystem, partners, customers, even competitors are very good to get you feedback. I'm okay if a competitor talk downs a peer company when they talk negative about their peer company, because that's human to talk down your competition. But the most dangerous idea is when a competitor says, I don't even know who they are. That means that company may not be exist or maybe a product. So the worst feedback you can get from competitors, I don't know them. It's very human to criticize your competition. And once in a while, you get this amazing feedback about a competing company, right? Where if someone looks up to a competing company, and of course, then you've identified something extraordinary, and particularly if you can do that at a very early stage, I think that is something, can create, a lot of returns.
All right, now moving on, you founded Ashoka Capital Advisors, and founding that must have been an exciting venture for you. What inspired you to make the move to WhiteOak Capital and, take on a new challenge?
Yeah, so, first of all, Ashoka happened because I had worked 10 years and the entrepreneurial bug came in 2013 to do something on my own. Unfortunately, just when I started early 2013, we got into the worst period of the Indian market. Interest, rupee crashed, inflation was at 10%, 10-year, 10-year bond was yielding 10%, the Indian sentiment, in fact, the small mid cap had a very terrible time till August, if I remember right, 2013. The market started rallying later in 13, once, the BJP nominated Mr. Modi as a prime minister candidate. Then things did start turning. So it was very difficult place to start as an entrepreneur and raise money for India. So actually, I had experience of not only investing in India, but a lot of countries outside India. So my initial entrepreneurial venture was actually looking at a lot of markets outside India. And that's very interesting because you can identify patterns and learnings from India and implement in those markets. And the reverse is also true, where you can identify patterns, how to understand industries and behave, and apply those learnings to the Indian market. And I think studying and investing in international markets gives you a lot more broader perspective to identify opportunities in Indian, in India, and then there's cross learning on both sides. WhiteOak Capital, the founder Prashant Kinta, I met him a few times. Of course, he had tremendous track record, at Goldman Sachs. And, we clearly figured out after a few conversations that our bandwidth, we had similar way approach to investing philosophy, process, very fundamental research-driven process of investing. And of course, honestly, when Prashant suggested that I should become part of WhiteOak, the founding team, I was too comfortable in my entrepreneurial venture. I was not planning to actually do something. And then he made this pivotal statement that I still recall. He said, I have left an extraordinary career positions in my life to start from zero in India. we're just starting in India, and there's an opportunity. At least we should aspire to create India's best investment management firm. And that's a line that stays with me. To the aspiration to create India's best investment management firm. Of course, it looked like a pipe dream at the start when in the office you don't have furniture or telephone lines, right? And in the initial days. But we always build the firm to I would say, the platinum standard. Work with the best-in-class service providers, work with the big four audit firms. We very early got some of the world's largest global institutional investors as clients, use the best tech. So everywhere WhiteOak has been, in every way, WhiteOak has been designed to create a world-class firm, and we never actually cut back on those investments, even in the period when we didn't have resources to invest in, including huge investment in research very early on for a startup. So, and those things, of course, have grown significantly since then.
You co-manage and manage around 11 schemes or so strategies at the fund house. Just wanted to understand, and can you walk us through your how you and your co-managers divide the workload, and how do you keep such broad perspective across all the strategies?
Yeah, great, thank you. So first of all, WhiteOak, we are blessed with having a very large research team in India. Across the group, we about 33 people. Focused on the Indian market. So it's one of the most resourced investment teams you can find in the asset management business in India. I'm not talking of just AMCs, but across the board, all formats of asset management in India. Again, it's an extremely, not only just the quantity, but the quality of, the typical sector leaders would have spent 15 years covering the sector at least. So there's just, lot of breadth, but also tremendous amount of depth in terms of the research capabilities. So I just happen to be one of those people, part of that team. So it's been to be part of an extraordinarily well-resourced team. Just to give you an analogy, it's like now the Indian cricket team, even if a lot of players are not playing or retired, and yet there are a lot of other backup players who come in and still perform exceedingly well. Which is the kind of depth the Indian cricket team never had, a couple of decades ago. So we have that resources. So I just happen to be, first among equals. And the way WhiteOak is structured is we assign a lot of responsibility to the sector leads. So unlike a lot of other structures where the fund manager is the key deciding factor or the be-all of investment decision making, here significant authority lies with the sector leads. And nothing like people who have spent 15 years plus covering the sector to decide where to allocate capital. So it's a very consensus, collective decision making. It's a very intense, I would say, discussion and debate culture where, even a single stock, the investment team spends a few hours discussing. It's again a very intense environment in the sense that we have team members who really love to do what, this is, we always believe that, if you only do something from 9 to 6, that's your job. What do you do after 6? What do you do on weekend is your passion. And we love to have people for whom there's no difference between work and passion. Then it's when you really enjoy what you do. And really that extra effort comes out and the results come out over time. So it's an intense effort that goes into research. We are very bottom-up research-driven teams. And my role, as a fund manager, is the biggest part of my role is actually making sure that we have clearly risk management principles and portfolio construction approaches that we have identified that those are followed. And I do exercise a negative veto on decision making, but it's not like I decide to buy a share in the portfolio. It's actually almost always with the concurrence of the sector leads. So it's the sector leads that have to recommend the position. once in a while, I exercise a negative veto on the decision. And that's even then there's a lot of discussion and a clear articulation of the reasons why, a negative veto is exercised. And many times a negative veto simply means we'll just wait out for something to happen, some development or some event to happen, and we'll revisit this. So it's a very, I would say, approach, unlike a lot of other structures, where there's a lot of collective responsibility and the involvement of the teams.
Sir, just wanted one clarification on these things. There are few of the co-managers which, in many of the schemes. So what's their role? Are they analyst also and they work as a co-manager or fund manager also?
Yes. All the senior leaders, including fund managers, are, for example, Trupti and Diresh, Trupti leads our BFSI research and also, consumer discretionary retail, right? Diresh leads the pharma, chemicals, building materials, logistics sectors. So all of them, and even actually, I actually more or less lead technology myself, because I've done a lot of technology investing earlier. So all of us also have, assigned responsibilities to take lead in covering a few sectors ourselves. So there is clearly that element that, and by the way, for example, Diresh has 15 years plus experience covering pharma and chemicals, which is a very intense sector. And for example, Trupti actually used to be a corporate, used to work in an NBFC as a, before she started investing in, and she's been part of WhiteOak since inception. So you have teams who have done that for, typically a decade plus team members.
Right now, I'm really curious about the investment philosophy that guides you in equity management. So could you share us give us a sneak peek of your approach?
Yeah. So first of all, people of course like to understand investment philosophies a lot, but I would say that investing, the big difference is not about investment philosophies. The real thing about investing is execution of investment philosophies. The real meat is not in difference in investment philosophy. It's really the execution. I'll just give you a different analogy. See, all of us know what you need to do for good health. Fundamentally, four things: eat well, exercise, sleep well, and live a stress-free life. By the way, we know this answer for thousands of years, including in ancient text, right? So the challenge of good health is not lack of knowledge of what to do for good health. Is the everyday discipline of following these four tenets well. So investing fundamentally is about execution. Now, coming to a philosophy, the philosophy is outsized returns are created by investing in great business at attractive price. So it's fundamentally the combination of great business and attractive valuations. Both have to come together, not one of them. So our first filter when we look at any investment opportunity is not looking at the price, but looking at whether it's a great business. So we start from that filter. The price is a secondary filter. So we start with a funnel of about 1,000 companies in the Indian market, which is typically the universe of companies with over 1,000 crore market cap for the AMC. We bottom up go by one company and individually rank the companies like 1 to 5. One are the businesses that typically we already own in our portfolios. 2 we'd love to own usually, but for price. 5 are the companies that are, most of the time those companies have corporate governance problems, or they are absolutely unsustainable businesses. 4 ranked companies are a mix of corporate governance and business problems. And 3 are companies that we're not sure. They can either be over time. Things are changing. Sometimes ownership is changing, where over time it may evolve into 2 or a 4, right? Over time. So we do this bottom-up exercise at least once a year. And of course, more companies go public, we do this. And out of this ranking of the lot of disproportionate research effort goes into companies which are ranked 1, 2, 3, which are typically ends up about 400 companies in this universe. And that is where the team spends disproportionate time identifying. And what do we mean by great business? Great business, in our view, fundamentally has 3 key attributes. First, the business needs to generate superior returns over incremental capital. Now, please note the focus on two words: superior and incremental. Superior means they have to generate higher returns than cost of capital. That is well understood. But the key word is incremental. Incremental means in the future. See, investing is never about the past. Investing is never about the present. All investment decisions are about the future. Effectively, you're taking a future view of every business. So just because the business has been good in the past does not mean it will remain a good business in the future. Yeah, newspapers have been a good business for 100 years. But clearly, the new generation, I struggle to see, with even my kids reading newspaper, right? They consume everything on the internet. So, so clearly, things change, environments change. So number two, you want to see companies with a strong, with a growth potential in India. So India typically, you assume 6 to 7% real growth in the economy and 5 to 6% inflation. India will expect to grow about 11 to 12%. You want to invest in companies and sectors which outgrow the economy. That's how you'll get better return in the market over a longer period. So you are constantly looking to invest in industries and companies which outgrow the Indian economy. Now, these companies are growing faster because they're gaining market share, usually by superior execution. And then the third factor of a great business is we are betting on companies which have a track record of execution. I'm not, which already have demonstrated some level of track record of execution. So you want the typical portfolio company is either a number one or number two in the industry it operates. Sometimes are smaller companies, but they are executing so well that they are consistently gaining market share. So over a very long period, they'll end up being one or two. That's why we invest in some of the smaller companies. And finally, even if you have all these three elements, and if governance is missing, then you don't create value. Then the owner creates value. If it's a good business and governance is missing, then it's a great business for the promoter, but not for minority shareholders. So governance is a very important, I would say, negative filter. And that's why we have a lot of focus on governance in our portfolio. And of course, there are market cycles where governance doesn't get. We're not saying poorly governed companies will destroy value, but we as fundamental investors don't know how to evaluate a poorly governed companies. If you don't trust the numbers or the people in the company, then how do you value the company? Fundamentally, that is the challenge. So that's why you need governance so that you can trust people and you can trust the numbers that come up the company.
Mr. Mantri, another thing was, you have been into managing typically into mid and small caps for a long period of time. The performance of the mid and small cap stocks have been phenomenal lately. In your view, is this momentum sustainable?
No, see, I think last 12 months, mid caps have done well, small caps have done better, micro caps have done still better. So as we speak today, clearly when we go down the market cap, the risk has gone up. So, for example, the SMEs are more riskier than micro caps are more riskier than small caps are more riskier than mid caps, and mid caps are more riskier than large caps. So today the risk pyramid is inverted. As we speak today, there has been correction in the last few days in small and mid caps. But even when we adjust for this, I don't think you can find broad-based opportunity in small caps and mid caps as we speak together today. The opportunity is a lot more challenging when you go in micro caps, companies outside the top 500. So I would say still it's a cautious environment. I think at least valuations have to drop by another 10 to 15% for us to even universe to expand reasonably that you want to look at. And to become attractive, we are a long way off.
How much more time will it take, sir? Means as you spoke, it will be 10% correction only to look at it. So what levels do you see when you can just start looking at the stocks or, investing in that particular stocks in the small and mid cap segment?
No, so we are invested as we speak. So what I'm saying is today the opportunity set that we like has narrowed, right? Where you like the combination of the business and the valuation. it was a lot more attractive a year back, right? And what I'm saying is, if there is a further correction from 10 to 15%, then the universe will expand. And to really become very attractive, and for me to say we should be investing a lot more in small and mid cap, the correction has to be much larger. When I mean correction, it doesn't mean price correction. It can be a value correction where the company's earnings grow, and through a time correction, the value gets built into those businesses.
As you mentioned, finding value in the mid and small cap space can be quite a task. Are there any specific sectors or industries where you see potential value today?
See, one, over a very longer period, the opportunity is across the board, right? But clearly, some themes or some parts of the market have got eaten up, and those are also seeing the brunt of correction of late. For example, the manufacturing story or the power, capex, cyclical story, and even real estate, there are a lot of high expectations now built into small and mid caps. I think the part of the market where there is value, particularly is in the banking and financial services sector, where company results have been good, but the sectors underperformed quite a bit, and particularly on the private bank side. And while, of course, the profitability in the short term has peaked, the margins have peaked, and some credit costs are going to come up. But I think overall, the valuations of the sector are very attractive. Pharma chemicals, again, is a sector. Chemicals used to be very hot, has gone through a fair amount of correction. That's where you have now more normal valuations. And because it's a very knowledge-intensive sector, pharma chemicals, so there is, for managers who are capable, there's opportunity to create a lot of alpha in the pharma and chemical sector. So valuations are normal in pharma chemical, and the opportunity of alpha has always been there in the sector. So these are the two broad sectors, I would say, where there is a lot of opportunity. Otherwise, because of the elevated levels of valuation in the mid and small caps, they're much difficult to call out smaller industries where things are a lot more attractive. One space where I'm a lot more positive in India is, I think, typically tech companies in India were designed to service the Western world. But now the Indian economy has hit a certain scale, and you have, and Indian companies were typically IT services companies. But now I believe enterprise tech softwares have started emerging in India, and there are a few companies now in India. And a lot of banks, a lot of government, a lot of establishment investing a lot more in tech. Anyway, we are way ahead of the world in financial services and deploying technology. UPI has been clearly a trailblazer, and so that's where I'm very optimistic of the technology opportunity in India. From just earlier, it was always about looking at the developed world opportunity. And by the way, Indian software companies are doing also exceedingly well in Middle East. And in fact, in Middle East looks at Indian banks for tech, inspiration rather than looking at the Western world, which actually uses very antiquated technology.
Sir, looking ahead, are there any particular themes you believed could be particularly profitable for investors over a long period of time?
No, I would say there's only one theme that's relevant, which is India. In a country which we can grow at 7%, a lot of things will do well. And of course, as the economy evolves, different sectors, share of the economy goes up. So, but I would say the opportunity is broad-based in India. We are seeing some early signs of, I'm not talking about stocks, but underlying economy. We're seeing early signs of resurgence in manufacturing in India, including even catalyzed by what's happening on the defense side, right? With a lot of focus on indigenization of defense. But remember, these are not, people overestimate. There's a famous saying of Bill Gates, that people overestimate what will happen in the next 2 years and underestimate what happens in a decade. So many of these sectors, we may be overestimating what will happen in the next 2 years. So people may be short-term disappointed with the pace of change. But over a decade, there's a transformative opportunity, in some of these sectors. Particularly if India has to get to 5 trillion and then go higher, the next, of course, goal is 10 trillion. We have to create new vectors of growth. So, for example, the two big industries where we are globally competitive, which is IT services and pharma, created the vector of growth for us to get to from, let's say 500 billion to, let's say, 3 trillion plus. But we will need new engines of growth. So manufacturing is clearly one of those engines of growth where, we have to build if we have to become a much larger economy. That's exactly Japan did. That's exactly Taiwan, Korea, Southeast Asian tigers have done, China has done. So if we have to evolve to a much larger economy, we have to get manufacturing right. But it's a much harder sector because you have to deal with the constraints of land, power, logistics, government approvals, port infrastructure. So it'll take much longer to build.
Coming to small cap stocks, when evaluating them, what are the three qualities that you absolutely will not compromise on?
So I think what you don't compromise on doesn't change with the market cap of the company. So first of all, you want to see companies with high returns on capital, and when I mean in the future, not just in the past. Number two, you want to, particularly in the small cap, you want to see them growing well because that's how you create alpha. There's no point of investing in a slow growing small cap, right? Then you can always invest in large caps, right? So you need to have the growth vector in a small cap in your favor. And you want to see managements that have track record of execution. And of course, as I said initially, the most non-negotiable factor is governance. If you can have a great business, but if the promoters are not aligned with the minority shareholders, then unlikely minority shareholders are going to create value. So that's the real non-negotiable factor. But then you need all these boxes to tick for you to create value. It's not like one.
So dealing with the inherent volatility and often limited information for the small cap companies must be challenging. How do you navigate these obstacles while choosing the stock in the small cap segment?
Yes. So one, we are blessed in this country that we have a very large universe of listed companies and a lot of companies going public. So you have practically an IPO a week or more. And this has to happen because, in India, the risk capital is provided by capital markets, So, and as the economy grows, new sectors, new opportunities will emerge. And so clearly, new companies will go public. So universe is constantly expanding in the public markets. And typically 90% of all IPOs are small caps, right? Just to context. So when you invest in small caps, you'll be always very cognizant of your liquidity. You're exactly right. But you don't have to take a concentrated portfolio in small cap. The universe is very large. So just to give you context, we look at 750 companies, from 250 to 1,000 companies. In fact, we have invested in a lot of companies even outside that universe. We invested in companies with even 1,000 crore market caps or lower. So that's the universe. So our team, because we have a large, deeply resourced team, we are able to invest in a large number of small cap stocks. So even just to give you a context, even in a flexi cap fund, we would be invested in 40 to 50 small caps, because, and many times, even if you want to take a large position, you cannot, because the company itself is small. It may be a great company, but today there's that kind of float is not available in the company for you to invest, deploy a lot of capital. But the universe is large and growing. And because we have this strong on the ground research capability, we are bottom up able to identify opportunity. Just to give you context, Chirag, just in case our multi-cap fund, we have more than 120 stocks.
How do you navigate this? What are the factors which you look, how do you navigate these challenges?
Challenges in terms of?
In terms of choosing, choosing the stock in the small cap segment.
Oh, so
because due to the limited information.
Sorry?
Due to the limited information which the small cap typically has.
Yes. So, that's a great, I like the space of limited opportunity. That means we can do our work and create alpha. if there's a lot of information available, then it, for example, let's say large cap, then the alpha is much harder to achieve. But if where there is a lot of less information available, it is opportunity for our teams to do work on the ground. And remember, many times companies, smaller companies, maybe going public late and they have very limited history in the public markets. But most companies, before they go public, have been in business for 20 years. So they have customers, they have employees, they have vendors, they have competitors. You can talk to all of them. And the promoter has also been around for 20 years and you can do a lot of due diligence on the promoter. So it's actually for bottom-up investors, that's a blessing that you have less information and less understanding. So there's more opportunity to create alpha because of that.
That's how you do it. For retail investors looking to dive into small cap stocks, what advice would you offer to help them make informed decisions?
See, one, understand, it's the process of buying stocks is very simple and it's become very easy over the time. You click a button, just like you order food, you buy a stock. In fact, probably the process is simpler because there's no physical delivery nowadays. The process of investing is easy, but the investing well is very hard, right? And that's something you'll only experience, and don't judge yourself investing experience just in the last 3-4 years when there's been a one-way market. Over time, markets will deliver volatility. So you look at performance over a cycle. I think the only place where people can invest in small cap is most individual investors tend to have themselves some expertise in one or two sectors. It's simply because they have a business in that sector or they work in that sector. So you are better positioned to understand businesses and do your own diligence, even better than professionals in that sector. So this is exactly the idea that Peter Lynch says, right? And other thing, people can look at consumer businesses, because consumer businesses where if you can observe a consumer trend early in your ecosystem, right? So Peter Lynch used to always go shopping with his wife and daughters, and just to very carefully observe what they buy and particularly what his daughters love to shop at. And that allowed him to identify very early consumer trends and brands and retailers who were doing well. So be a very careful observer of what people consume in your family, in friends, in extended family. And so there are two spaces where you can invest. One on the consumer and one in a sector where you have your own expertise because of your own business or you work in that sector.
You have been into investing into small and mid cap and known thing, which is a very known thing. So every investor has some story about their first investment. Could you share your story and what company was it and how long did you hold on to it and what was the outcome of that particular stock?
Great question. So one of the first earliest stock I invested, was TB18 CNBC. When I started seeing the bull market, I said, market is doing well. Everybody is watching CNBC. So, the company will do well because they'll now get a lot more advertising. And, in a media business, after a certain fixed cost, large part of the revenue turns into profit. So, and I invested in that company, knowing that in a bull market, CNBC is a very large beneficiary. The business, media is very large beneficiary. I had very little money. And in a couple of months, the stock doubled, actually. Remember, this was the bull market, real bull market, unlike the markets. Even the 2003-07 market was a different level, right? And I was a very naive investor. So I sold it because for me, doubling money was too much, a lot of money in those eras. I think it went up 20 times in the next 4 years from there. So you can imagine how bad decision maker I was. So one of the learnings is when you find great companies and opportunities, stay with them for a long period. Doubling money is just nothing. So one of the big learnings, of course, in life is focus on quality businesses and stay longer with them. Of course, I was a very naive investor at that time.
Reflecting on your extensive experience in the investment world, what has been the most surprising market trend or event that you've witnessed, and how did it influence your investment strategy or philosophy?
It's a great question, and very actually a brilliant question, and really not thought so much about it. I would say one learning is, and I'm now getting that learning more and more, that everything is cyclical. Nothing is really permanent. So no company is great forever, and some very mediocre businesses also may change a lot. So I think the most dangerous idea in investing is to have a closed mind, is to have very strong beliefs about some things. I think the greatest asset as you can have an investor is having an open mind. It's harder because when you start believing you have 20 years of knowledge, you know things. And the other learning, of course, is how little we know about anything. You can spend 20 years covering a sector or a stock, and you realize 20 years later how little you know. So just keep a lot of humility in trying to learn and understand things. And even when you spend decades doing something, realize that you are prone to error and you don't know. So saying a lot of time, I don't know, I don't understand, is a great place to start.
Right. Well, that's all for today. We hope our viewers benefit from the insights that you've shared. And once again, thank you for joining us and answering these questions. Thanks.
Thanks a lot. Have a
Thank
nice
you,
day.
sir.
Thank you.